All right, we're going to talk about the solutions to this chapter, looking at variable costing versus absorption costing. First and foremost, that any kind of differences here, oops, get my pencil out here. Okay, that differences between fixed and variable costing are attributable not to this a generic term of fixed manufacturing cost, but only to fixed manufacturing overhead cost. Okay, not all fixed costs are going to be product cost. Some fixed costs are always going to be expense, such as marketing or any kind of administrative cost. So to say that all fixed cost, no, you have to be careful. Fixed manufacturing. And that's kind of what we're getting at here with number 3 as well, that the differences are in the fixed manufacturing overhead. All right. I think most of these problems here, okay, the question is one of timing, okay? All costs eventually get recognized as an expense. The problem is that what goes into a product, such as inventory, okay, all those manufacturing costs are there. When are these costs released? When are they expensed? Well, under variable costing, if it's a fixed cost, it's expensed immediately. Under absorption costing, fixed manufacturing overhead would be a product cost and would be only expensed when it was sold. So if there's if inventory is held back, if not all inventory is sold, some of those fixed costs stay in inventory. They're not expensed. All right. Variable costing does not, I repeat, does not treat fixed cost as being irrelevant. Quite the contrary. It actually puts a much more of an emphasis on fixed costs because you can very clearly see, oh, these are a fixed cost. We have to cover those. We can't hide any of those fixed costs in inventory and not recognize it. So in fact, it really does. And quite honestly, the other thing, it doesn't matter that the impact of it is really on operating income. That's really the primary measure is what's happening to operating income as my sales change. Not so much, okay, well, which costs are going into the product or anything else, but what is my operating income? What is my net income? All right, number 7 gets at the problem that we have with absorption costing, and that is that absorption costing, operating income is a function of not only sales, but also changes in inventory. And that really confuses and confounds the problem for management to try to understand what's happening. All right, we're going to skip down here to the issues of capacity. Okay. These, number 11, just the, if you will, sort of a hierarchy starting from theoretical to practical, normal, and master budget, okay? Theoretical just means if I run flat out 24/7, 365 days a year, how many units could I possibly produce? Not very practical, but in theory it could be done. Practical capacity is exactly what the word means. If you take these machines and if I begin to discount it for time off, maintenance, vacations, things like that, then how many units could I produce? But theoretical and practical are always going to be based on what the machines can do. It's going to be based sort of on an engineering. Whereas normal capacity and master budget capacity are based on the market, what people want, what the demand might be. Normal capacity is sort of an average annual demand over an extended period of time, 3, 5, 7 years. Master budget is simply what's the demand going to be next year. So those are all potential levels of capacity that I can use in coming up with a predetermined rate to allocate my fixed manufacturing overhead. The bigger issue with respect to capacity is not the choice of that, but rather, in other words, how I'm going to allocate overhead, but rather what kind of decision do I make in terms of buying the equipment? What kind of capital decision do I make? How much financing do I need? What am I going to build? And it's a very, very expensive proposition, not only in terms of the capital equipment you're going to buy, but just the cost of acquiring the money. Okay, that you have to pay processing fees, a lot attorney fees, accountants fees, you name it, in order to get major funding like that. So it's an expensive proposition. You don't have to do it too many times. The downward spiral, or sometimes called the death spiral, is that as my sales decrease, I have less and less, my denominator decreases. So that means I have less units to allocate that fixed manufacturing overhead over. So in fact, really my cost per unit begins to increase. And if I really am not careful about that, I end up actually pushing the cost higher than my competitors, which kind of exacerbates the situation, and I end up it really costing more. And so the emphasis here is really on maintaining sales, maintaining price to maintain my sales. All right, now let's take a look at number 16. Number 16 is a fairly simple problem in terms of 2 months looking at the difference between absorption and variable costing. A couple of basic assumptions, which is always kind of nice. In the margin over here, or however you want to do it, I like to put in a couple of the important points. First of all, the selling price is $24,000 per car. Likewise, they tell me that the fixed manufacturing overhead is $2 million per month, and the budgeted rate of production is going to be 500 units. So if I take the 2 million divided by 500, it means I'm going to have fixed cost of $4,000 per car that I'm going to allocate to it. My marketing cost, my fixed marketing cost, $600,000. I don't have to do anything with that because that's kind of stuck there. That's going to be, the $600,000 will be a period cost no matter whether I use absorption or variable. My variable manufacturing overhead costs are $10,000. Okay, and that's kind of fixed per unit and each month. Likewise, too, each month I'm going to have $3,000 of marketing costs. Now, keep in mind, this is a function of what's produced. Marketing is a function of what is sold. So I'm going to use two different activities when I go to create my variable cost statement. Okay, my total under absorption, my total cost per car would be $14,000. Under variable costing, it would be 10. So we'll take a look at the creation of these income statements. But before we do that, first of all, we need to be kind of clear that in this case, in the first month, that inventory is increasing from 0 to 150. So as a general rule, okay, when inventory increases, and let's always kind of compare it with absorption costing will have the highest operating income. Now, in May, the inventory levels fall from 150 down to 30. So as a general rule, again, always comparing using absorption costing, when inventory levels fall, absorption costing will have lower operating income than does variable costing. Let me repeat that one more time. When inventories increase, as they do in April, absorption costing will have higher operating income than does variable costing. When inventories decrease, as they do in May, then absorption costing will have lower income than does variable costing, generally speaking. All right, now, what they did here is kind of what I did initially, create this basic information that I can then plug into my two different income statements. Now, there's no particular reason that I have to do one first or the other. It's whatever your choice. In this case, they ask you to do variable costing first. Now, sales are always going to be sales. Doesn't matter the method I'm using. All right, now, under variable costing. Variable costing, by its strict definition, means the only costs that go into inventory, the only costs that I'm going to capitalize to inventory are my variable manufacturing costs. So at $10,000 per car, if I produce 500 cars, okay, I have $5 million of inventory that I'm creating, which would also be my goods available for sale. Since I have 150 cars left over, take 150 times 10,000, that's 1.5 million. Or my variable cost of goods sold are 3.5 million. And again, this is something you haven't seen up to this point, but it still, you can kind of tweak the variable cost statement however you like to maintain the basic definition of revenues minus all variable cost equals contribution margin. Well, the other thing I have to factor in here is my marketing cost, and that is a function of sales, not production. The 5 million is a function of production. This is my $3,000 times the sales of 350 cars, which gives me the variable operating cost of $1,050,000. Add that to the 3.5 million. This gives me my variable, okay, total variable cost, which is made up of my variable cost of goods sold and my variable operating cost. Hence, I get my contribution margin. Subtract out fixed cost, because by definition, all fixed costs are period cost, and I end up with operating income of 1.25 million. Now, do the same thing over here. I'm not going to repeat all the numbers. You can kind of see what they do, starting with beginning inventory. In this case, they're producing 400 cars. So you have the 4 million is added to it, less the, double check the 30 cars left over in ending inventory. So you end up with the cost of goods sold plus the marketing cost go up slightly because you're selling more cars. And so you have a little bit higher contribution margin. Well, I would expect to have a higher contribution margin in that. In April, they sold 350. Here, they're selling 520 cars. Okay. Oops. So I'm not even going to try to do that. Okay. So as my sales go up, my operating income goes up, gives me exactly what I would have anticipated. All right. Well, let's take a look at absorption costing. Again, revenues are revenues. So it says beginning inventory 0. The two costs that are added here are my variable manufacturing costs, like I did above, and all of my fixed manufacturing. In other words, they're budgeting, taking the fixed manufacturing amount of 4,000 and taking that times the 500 cars that they actually produced. So you're coming up with that rate of 4,000 per car. Since they applied it, okay, all of it got, since their budget equaled the amount of production, all of the fixed manufacturing overhead was applied. So the cost of goods available for sale is the 27 million. 350 times 14,000 gives you the 2.1 million. Cost of goods sold here 4.9. Gross margin of 3.5. Subtract out all the non-manufacturing costs, because under absorption, the line here, okay, is between manufacturing and non-manufacturing. Under variable costing, if I were to kind of draw that line, okay, this is variable cost versus fixed cost. Okay, and so I have the 1.85 million, which is exactly what I would have anticipated. In other words, remember I said because inventory was increasing, I would anticipate, at least with respect to year 1, or the first period here, absorption costing would have more operating income than would variable costing. Okay. Now, you can look through that and do the same thing. Two things I would point out with respect to the absorption costing income statement. Number 1, they budgeted for 500 units of production. So that means they come up with a predetermined overhead rate of 4,000 fixed costs per car. Well, if they only produce 400 cars, it means that they're off, okay? It means that they are off by 400,000. 400,000 was not applied. Now, GAAP is very consistent, very adamant that all manufacturing cost must be included in the cost of production. Okay, all those manufacturing costs have to be there. You can't just say, well, I can ignore that. If you incur it, you have to pay for it. You have to recognize it. So I have to create this thing called a volume variance. I didn't have to do it in April because they planned for 500 and they actually produced 500. So in a sense, I have to make a catch-up entry here. And this catch-up entry is basically an addition to my cost of goods sold. Now, sometimes what you'll see here would be to take the 7.7 million less the 420,000 to get kind of a preliminary cost of goods sold, then add the variance. It's an unfavorable variance because I have to add to it. I have to increase the cost of goods sold, increase the expense, and whenever I increase an expense, I lower my income. Hence the definition of it being unfavorable. It is possible that you overproduce. Okay, you produce more than what you would anticipate. You overapply. So in that particular case, if I'm taking it out of cost of goods sold, it would be a favorable variance. Now, again, because inventory went down, I got the sort of consistent results that I anticipated, and that with inventory going down, my assumption is absorption costing would have less operating income than would variable costing. Okay, so those are the major takeaways from this particular problem: how to do variable costing, how to do absorption costing, and then be able to explain the differences between the two as being the change in inventory times the fixed cost per unit that would be applied. Okay, the last one I want to take a look at in this particular chapter deals with the issue of capacity. So what you need to know would be, what are the four levels of capacity? You know, in this case, theoretical capacity, practical capacity, normal, and master budget. What are they? Okay, what does it mean to do that? And in some cases where they give you the numbers, what would be the level of production that they could achieve here? Okay, so in this particular case, okay, they give you the basics that under the theoretical, they're going to operate 3 shifts. They can make 5 motorcycles per shift times 360. Okay, they're using that. So they can produce, therefore, 5,400. In this particular case, they're adjusting downwards the number of motorcycles to 4, and for 320 versus 360, so the number goes down. Now, remember that A and B, the practical and theoretical, are based on what the machines can do, what the equipment can do. Normal and master budget is based on what the demand is going to be, okay? So the normal capacity utilization is assumed to be 3240. That is over an average period of time. That's what we think it's going to be over the next 3, 5, 7 years. Okay. However, which is unusual, but it does happen, that in the master budget as for the next year, we think it's going to be 3,600, which is a little bit higher. It's kind of an unusual situation, but it could also be that maybe they're beginning to bump up against the maximum capacity that they have here. So the implications of this are, what are the levels of capacity? If I gave you information, would you be able to calculate the amount of production, okay, that would be required with each of those levels? But then the next question is, looking down here, what's the implication? Well, the implication is that given that this amount is fixed, that's not going to change. This is what's changing, my level of capacity, so that I am coming up with this predetermined overhead rate. That is, I'm taking that, dividing it by an activity, that is my production, and I'm going to allocate that fixed manufacturing overhead to each product based on that level of capacity. And as you see, as we go from theoretical down to normal and master budget, because the denominator is decreasing, getting smaller, the cost per unit is getting greater. So from a cost allocation point of view, the more capacity that I can utilize, the lower my cost. That's why there really needs to be a huge, huge emphasis on sales, so I can push my capacity, push my level of sales out there, so that I can increase my capacity, increase my annual production to bring down the so-called average cost, this cost of fixed manufacturing overhead. It also explains, as I kind of alluded to in class, why some companies are very reluctant to expand production, because they know that production cost, particularly something like fixed manufacturing overhead, is not a linear cost. In most cases, it is a huge step cost. So they have to be very, very much convinced that they can not only increase sales, but very quickly increase sales, so that if they actually do expand production, that they're not left on the low side of that next step up, so that they've actually increased their production capability, but they've actually increased their fixed cost as well, their fixed manufacturing cost per unit. So if they're not convinced of that, most companies will say, we're just going to stay on this side of that step until we're sure that we can very quickly move beyond that threshold and get to this point where we really haven't changed the overall fixed cost per unit.